If you're looking for safe investing strategies in 2026, you are probably stuck in the middle of the oldest battle in finance: cash versus stocks. Everyone wants to know where to invest money right now, but the answer isn't as simple as picking a winner and a loser. Here is the scenario. You have $10,000. Maybe you worked hard for a year to save it. Maybe it's a tax refund. Maybe it's an inheritance. You have two doors in front of you. Door number 1 is the high-yield savings account. It feels warm and fuzzy. It's safe. You put your money in, and the bank guarantees to pay you interest every single month. You never lose a penny. You sleep like a baby. Door number 2 is the S&P 500. It's the stock market. It's the engine of the American economy. History says this door makes you rich. But you also know that sometimes this door slams shut on your fingers. The market crashes. Portfolios drop by 20%. People panic. So in 2026, with interest rates moving and the economy shifting, which door do you choose? Most people make this decision based on fear. They are afraid of losing money, so they choose the savings account. Or they are afraid of missing out, FOMO, so they dump everything into stocks at the wrong time. Both of these people are wrong. If you choose the savings account for the wrong reasons, you are practically guaranteeing that you will work until you are 80. But if you choose the S&P 500 for the wrong reasons, you might be forced to sell everything at a loss when you need cash the most. In this video, we are going to settle this debate once and for all. I'm going to run the math for you. We are going to look at the psychology of safety versus the math of wealth. I'm going to show you exactly what happens to your money in both scenarios over 15 and 20 years. And by the end of this video, you won't just guess where to put your money. You will have a precise strategy, a time bucket system that tells you exactly where every dollar belongs in 2026. So, stop guessing and let's look at the numbers. Let's start with the contender in the blue corner, the High Yield Savings Account, or HYSA. I have to say, I love HYSAs. In 2026, these accounts are still the bedrock of financial stability. But let's be clear about what they are. This isn't your grandfather's savings account at a brick-and-mortar bank that pays, 0.01%. A high-yield savings account is an online bank account that pays you competitive interest rates, usually 10 to 20 times higher than the national average. So, why do they pay you this much? Well, it's because they don't have overhead. They don't have physical branches, expensive marble lobbies, or thousands of tellers. They pass those savings on to you in the form of interest. The superpower of the HYSA is stability. If you put $10,000 into a HYSA paying 4.5% APY, you know exactly what happens. In 1 year, you have $10,450. You didn't do any work. You didn't check a stock chart. You didn't panic when the news talked about a recession. It is risk-free return. It is FDIC insured. It is liquid, meaning you can grab that cash whenever you need it. So, when does the HYSA win? It wins whenever you need the money in the short term. This is your shield. This protects you from life. If you are saving for a wedding in 12 months, this is the winner. If you are saving for a house down payment in 2 years, this is the winner. And most importantly, for your emergency fund, that 3 to 6 months of expenses, this is the undisputed champion. You do not gamble with your rent money. You do not gamble with your safety net. The HYSA is where you park money that has a job to do in the next 1 to 3 years. But there is a trap. And honestly, it's a trap that keeps millions of people middle class forever. It's often called the silent killer of cash. Yep, inflation. The safety of a savings account is really just an illusion if you leave your money sitting there for too long. Why is that? Well, because of inflation. Inflation is basically the rate at which the price of goods and services goes up over time. So, for example, if a gallon of milk costs $4 today and inflation is 3%, next year that same milk costs $4.12. Now, let's say your high-yield savings account pays you 4.5%. That sounds great, right? You must be making money, surely. But if inflation is running at 3%, your real return is only 1.5%. You're barely treading water. Now, imagine interest rates drop. In 2026, the Federal Reserve is going to play a massive role here. If they cut rates, your savings account rate drops instantly. It might go from 4.5% down to 3%. And if inflation stays at 3%, your real return is, well, 0. You feel safe because the number in your bank account is going up, but your purchasing power, what you can actually buy with that money, is just stagnating. If you keep all your money in a savings account for 20 or 30 years, you aren't building wealth. You're just preserving it. You're playing defense, not offense. And honestly, you just cannot win a game by only playing defense. I want to pause here for a second. We're about to switch gears and talk about playing offense. How to actually grow your wealth significantly. But if this breakdown of real returns and inflation is helping you see your money a bit differently, please hit that like button. It tells YouTube that this is quality education, not just hype. And if you're new here, go ahead and subscribe to the channel. We're building a library of videos just like this to help you master your psychology and your wallet. Join the Mind Over Money HQ community, and let's get rich together. Okay, now let's look at the heavy hitter, the wealth builder, the S&P 500. The S&P 500 is not a bank account, it is a basket. When you buy an S&P 500 index fund like VOO or SPY, you are buying a tiny slice of the 500 largest, most profitable companies in the United States. You are buying Apple, Microsoft, Amazon, Google, and Berkshire Hathaway. You are betting on the American economy. Historically, over the last 100 years, the S&P 500 has returned an average of about 10% per year. Now, 10% versus 4.5% might not sound like a huge difference. It's just 5.5%, right? Wrong. Because of compound interest, that small difference is worth millions. Let's run the numbers. Imagine you invest $10,000 today and you add $500 every month for 30 years. In the high-yield savings account, assuming an optimistic 4% average, you end up with about $350,000. That is not bad. It is safe. But in the S&P 500, assuming the historical 10% average, that same money turns into $1.1 million. That is a $750,000 difference. That is the difference between retiring on a beach and retiring on your couch. That is the difference between leaving a legacy for your kids and relying on Social Security. This is the power of the S&P 500. It is your spear. It attacks inflation. It grows your purchasing power. It builds generational wealth. But there is a catch, and it is a big one. The price of admission, folks, is volatility. The S&P 500 does not go up in a straight line. On average, it goes up by about 10%, but average is a really tricky word here. One year it might be up 20%. The next year it could be down 15%. The year after that it might just be flat. This right here is what we call volatility. Now, if you need your money next month and you put it in the S&P 500, honestly, you are gambling. Imagine you put your house down payment in the market, and then, just the week before you need to write the check, the market drops 10%. You've just lost thousands of dollars, and suddenly you can't buy your house. This is why people lose money in stocks. Not because the market is some sort of scam, but because they have the wrong time horizon. The stock market is, quite simply, a device for transferring money from the impatient to the patient. If you panic when the line goes down, you lose. If you hold on, historically, you win. So, how do we choose? How do we balance the safety of the shield with the power of the spear in 2026? Here's the verdict: the time bucket strategy. The winner of S&P 500 versus high-yield savings isn't one or the other. The winner is you, but only if you use the time bucket strategy. This is the exact framework I want you to use in 2026. Bucket number 1. The safety bucket, covering 0 to 5 years. Money you need for bills, emergency funds, travel, a wedding, or a house deposit within the next 5 years goes here. The vehicle for this is a high-yield savings account. The goal? Preservation. Why? Because, quite frankly, you cannot afford to lose 20% of this money right before you need it. We accept lower returns for peace of mind. Bucket number 2. The growth bucket, for money you won't need to touch for at least 5 years, and honestly, preferably 10 or more. This is the money set aside for retirement, financial freedom, or just building wealth for at least 5 years, preferably 10 plus. The vehicle of choice here is the S&P 500 Index Fund. The goal? Maximization. And here's why. Historically, over a 10 or 20-year period, the probability of losing money in the S&P 500 drops to nearly 0. We accept the bumpy ride because, well, we want the destination, that $1.1 million. So, here is the mistake most beginners make. They see those high interest rates in 2026 and think, 4.5% is guaranteed. I'll just put all my money there. That feels smart today, doesn't it? But in 10 years, you'll look back and realize you missed the biggest wealth-building opportunity of your life. You played it safe, and well, you paid the price in missed growth. On the flip side, don't throw your emergency fund into the stock market trying to get rich quick. That's exactly how you end up selling at the bottom, when life punches you in the face. So, here is your homework assignment. I want you to look at your bank account right now. First, calculate your emergency fund. That is 3 to 6 months of your expenses. Move that immediately to a high-yield savings account. If you are keeping that in a checking account, paying 0%, you are literally throwing away free money. Second, look at what is left. Do you have excess cash sitting there? Do you have money you won't need until 2030 or even 2040? That money needs to get to work. Open a brokerage account. Set up an auto transfer. Buy the S&P 500. And then, this is the hardest part, ignore it. Do not check it every day. Do not check it every week. Let the American economy work for you. Building wealth isn't about being a genius. It's about being disciplined. It's about understanding that money is a tool, and different jobs require different tools. You wouldn't use a hammer to cut a board, and you wouldn't use a saw to drive a nail. Use the savings account to protect your today. Use the S&P 500 to build your tomorrow. When you combine them, you become unstoppable. I know the financial world can be scary. I know the news is always screaming about the next crash or the next crisis. But remember, optimists get rich. Pessimists just sound smart. Stay the course, fill your buckets, and let time do the heavy lifting. Now, I want to hear from you in the comments. I'm curious about where you stand in 2026. What is the one big thing you're saving for right now? Is it a house, a car, or just pure financial freedom? Let me know in the comments below. I love reading your goals. It inspires us to keep making these videos. If you found value in this breakdown, please share this video with a friend who might be hoarding too much cash or taking too much risk. Let's help them find the balance. Don't forget to like and subscribe for more no-nonsense financial education. Keep building, and I'll see you in the next video.